Welcome back. And I'm in chapter 7, and we're on video 2 now in that chapter. And we're going to look at venture capitalists. And we'll take this for about 10 slides or so and see where we get to. All right, venture capitalist. A person or firm that provides external equity capital to new firms with promising growth potential. Wow, it's a lot there. So it's either a person or like a company that has money, which is capital, that's money, and they're going to finance new ideas. And so you might be thinking of a television show called Shark Tank. And on Shark Tank, there's people there like Mark Cuban and others who have a bunch of money, and they also know how to make a product, how to get it delivered. They're very good at marketing. They're very able to get a product delivered out there to the public and have it catch on in the public. So we call them like an early stage investor. Like when a company's new, you have that new product that you think is going to do wonderful, that new food or that new garage vacuum or whatever it is, and you need a venture capitalist because it's kind of hard to raise money in the traditional sense of selling stocks and bonds. And often companies start by going to a venture capitalist, or sometimes. They maintain strong oversight. If you ever watch Shark Tank, especially in some of the episodes, the person with the money is like, well, you're going to do this and you're going to do that. And they have this, the person who's financing it, the venture capitalist, it's either like their way or the highway with how things are going to go down. You know, it's their money, it's their way. And so that's what they mean by maintain strong oversight. They're going to decide whether the product's going to be sold on QVC or Amazon or both or in traditional stores, and how the message is going to get out to the public. And they also have a clearly defined exit strategy. Venture capitalists aren't really in it for the long haul. They like to finance new ventures. It's exciting and they enjoy it. And then once the venture has taken off and it's doing well, they cash out. So they have a clearly defined way to get out of a certain arrangement so they could go to the next new product or service. An angel capitalist is different. It's a person or firm that provides startup equity to promising firms. Well, that's the same. However, they do not try to run the business. So what that means is they're much more relaxed with oversight. They're not trying to tell the inventor, so to speak, what they're going to do and how they're going to sell it. They just give you the money and let you do it your own way. So they don't want to get in the way of something and somebody they believe in. So and we call them an angel because how often are you going to find someone like that? Here's a bunch of money, but I don't want to control you. Probably not very often. Initial public offering. That's a primary market event. Let's explain what that means. When a company is selling its stock to the public, when it's new, it sells the stock to the public, and so the company sells the stock to the public. That's what we mean by a primary market event. When you're buying stock online on Thinkorswim, you're not buying it from General Motors or Ford or Tesla or Philip Morris. You're actually buying it from another person who owns it. Now, that's really a secondary market event. So what they're trying to say here is when a company first issues stock, we call it an initial public offering. And we also call it a primary market event. A private firm, like a sole proprietorship, which we discussed very early on in the course, they sell stock to the public for the first time. Newer firms often get to a point, in other words, it's been out there and it's been growing and it's been privately held, but they get to a point where where things really take off and they could be opening new locations all around the country, but they don't have the money. And so they would go for what's called an initial public offering. They would sell their stock to the public. They'd bring in a bunch of new owners and the cash that goes along with it, and they'd really be able to finance a much faster growth rate, opening those new stores at a much quicker pace. Maybe there's 100 spots where a Trader Joe's would do well, but the private owners, they need external equity. They don't have enough money, so they're going to go public. and we call that an initial public offering. They're going to sell like $100 million worth of stock and use those dollars, which represents new owners' money, use those dollars to build new stores around the country. An investment banker, what does he or she do? An investment banker. It's a bank that does many things for firms. We also call the people who work there an investment banker, but it's also a bank. And we'd actually call it an investment bank. But it's a bank that does many things for firms. One thing it does is facilitate the IPOs. That's what we just discussed. In other words, initial public offerings is IPO. That's from the last slide. And so what we're saying is it helps firms go public. So that they bring in more capital by selling new shares of stock. So if I'm a company and I've been privately held and I want to go public, a way to do that is you contact an investment banker, and the investment banker helps value what the firm's shares are worth and then gets them delivered out to the public. A prospectus. So when a company is going to issue new shares, it needs to tell the world what the shares are like. Much like you have a prospectus when you're going to invest money into a retirement plan. It might call it like a prospectus. But this is really a company selling stocks to the public. And so for the first time, it's a primary market event again in this instance. It's a sales tool. It describes the IPO firm. It lists the managers, the assets, the financial position, the product, the service, etc. The Securities and Exchange Commission, well, now that came into being in the mid-1930s. What it does is it wants to make sure the profiles of the managers, the list of assets, the financial position, that all of that's accurate. All they do is test to make sure the managers really exist, that the CEO, for instance, she really does have an MBA from Harvard, that the company really does own the factory, the assets and other factory items that it says it owns, the other assets. And so it really just looks at the items bulleted above, and it makes sure that it's all accurate. And they have 20 days to do that. And that would be like a month because it's 20 business days, Monday through Friday. They never will say that the stock is priced correctly. So this is the Securities and Exchange Commission is related to the federal government. They're never going to say, oh, this is a great deal or this is a bad deal or the price is correct. All they're going to let us, the rest of the world, know is that the profile of managers is correct, the list of assets is correct, the financial position that's stated, the balance sheet and income statement, they're both audited, they're both correct as far as we know. They only check to make sure the information in the prospectus is accurate. So what used to happen, to have a little bit of an understanding of this, what used to happen many years ago is before the Securities and Exchange Commission did this, is people would go door to door and sell stock in companies that didn't exist. It was just a big scheme. And so the federal government protects us. It protects us from polluted air, polluted water. You know, vehicles should have seat belts. It looks at our food, our drug administration, our Food and Drug Administration. It protects us. This is another way it protects us. It protects us from unscrupulous people selling us stock in companies that don't exist. And that's done through the review of this prospectus. So they look at it for 20 days. So if a company wants to sell stock to the public, it creates a prospectus, it makes sure it's accurate, and then it sends it to the SEC, who has it for 20 days. If the 20 days is up and you haven't heard back from the SEC, you're good to go to sell the stock to the public, to deliver the prospectus and stock to the public. A red herring prospectus, that's a prospectus that's delivered before the 20 days is up. It's issued during the 20-day waiting period that we just discussed. During this time, we're waiting for the SEC approval to sell the shares. It's preliminary only. In other words, it's not quite done. It does not include pricing details. It will not tell you the price of the stock. It'll just give you the information. It'll call it a red herring or preliminary prospectus, letting prospective investors know it has not yet made it through the underwriting process. Underwriting, well, let's see what that's about. Here the investment bank takes on risk. The investment bank, remember they've helped the company, their idea is to help the company deliver the stock to the public. So here what they do, they first determine the value of the firm. And we're going to do that in this chapter with the free cash flow model. But they would figure out the present value of the company's free cash flow. That's money that's expected to be paid to bond and stockholders throughout time. And they got a present value of $100 million. So that indeed is what the company's worth in my example here. Further, they plan to sell the 10, so what they plan to do to get to 100 million of value is sell 10 million shares at $10 each. They decide to break that $100 million value into 10 million shares, selling for $10 each. With an underwritten issue, what happens is the investment, when we say an issue is underwritten, what they do is they buy up all the shares at a discount. So the investment banker says the company's worth 100 grand. We're going to pay you, $100 million. We're going to pay you $94 million for all those shares. And then having purchased all the shares, it subsequently sells them for $100 million, pocketing the $6 million profit, the $100 million minus the $94 million that it paid for the shares. And so the risk it takes on is what if, like of what we're in now with coronavirus, if it buys up a bunch of shares and the market tanks, it paid $94,000 for them and it can't sell them for anywhere near $94,000. That would be why they tell you in that first bullet, the investment banker here is taking on risk. Risk is that the shares actually end up selling for less, like $9.10. And so that's the end of those slides, and we're going to continue on probably on the next class time and start talking about how to value stock. Thank you.